let me just on one point that I'm glad you brought up 2008. When that happened, when the price fell from 1,000 to 700 in gold and 21 to 9 in silver, what was very interesting in my market was that there wasn't an ounce of gold or silver to be found for the second half of the year anywhere. I thought we were going out of business, and I'm dead serious. In 2008, the U.S. Mint shut down a half a dozen times. The Perth Mint in Australia ran out of product for the first time ever, took no new business after August. The Rand Mint in South Africa was cleaned out. One wealthy Swiss businessman flew a 747 there and cleaned them out for the first time ever. The Canadian Mint, the Australian Mint, and the Canadian Mint, the Austrian Mint, the UK Mint were working 24 hours a day, 3 shifts, 8 hours apiece, and they were as much as 12 or 14 weeks backordered across the board. And nobody, I mean nobody, sold anything. I am a authorized reseller of the U.S. Mint. They said we will take no orders. We'll let you know when you can take it. And when they finally came back online, months and months later, into the fall, right around this time, they said, "Fine, we'll take your silver maple leaf order or your silver eagle order. With $9 silver, you're going to pay 18 or 19 bucks, and you're going to wait 8 to 12 weeks to get your product. You got to pay up front." And the same thing was true with gold. What I'm saying is it was a paper-derived smash-down drive-by shooting. And if you do that now with naked shorts when silver's in backwardation and the exchanges are being bled dry, that's exactly the environment that these traders across the globe are going to jump all over and say, "Fine, we'll stand for delivery. Where's the product?" And that to me is an existential threat. And I wonder, is it true to you that the only way to manipulate a market is to push it in the direction that it is going? But when you throw in the delivery ability to stand for delivery, like we're seeing in silver and the chaos that's creating in both physical silver and in SLV, I don't know. I think it's something that these traders would need to think very, very cautiously about, because I can tell you in the physical world, there was not one person that sold anything and the price just cratered. So I don't know. It's nuanced for sure, but again, could it be different this time? Don't know. It feels it to me in my gut, but I defer to you guys. You have the career in technical analyzing these markets, and I respect that. Yeah, I mean,
Andy.
Yeah, well, I mean, look, I look at what's going on with the carry trade. You got Japanese pension funds pulling out 1.1 trillion out of U.S. treasuries now because keeping money in America loses them money after hedging costs. And when you have Japan stop buying, interest rates wouldn't just stay flat; they would arguably explode. And and I think that's the issue. When you have 1.2 trillion in borrowed yen funding crypto stocks, emerging markets, all this stuff has to unwind. And every hedge fund, every momentum trade, every leverage bet built on free Japanese money is getting margin called. I think it is a very important trade. And I don't know, December 18th is a big day for Japan. There's a 50% chance they hike again. So what happens then? I guess you could say the world's biggest piggy bank just got smashed a little bit. I don't know. It seems that way to me. It seems big, very big, and I would agree that it's probably bigger than people think. It's interesting because the public is really hasn't been a massive participant in the gold rally. It's been more along the lines of the central banks and whoever the heck is importing billions upon billions every month into COMEX, the sophisticated traders. Maybe it's some of the people listening to the chief investment officer of Morgan Stanley who said, "Sell half your bonds and put 20% into gold," or Michael Hartnett from Bank of America who said, "No, make it 25%," or Jeffrey Gundlach who said, "No, 25% is not overweight." Things I never, ever thought we would hear. I think the public is behind the curve. And if you look at the recent data, they're all in the stock market, highest ever, largest margin debt ever, largest option exposure ever. The public's in the market. The big money, the central banks, the commercial banks, the sovereign wealth funds, they're the ones that have been driving not only the gold accumulation, but the deliveries off of the exchanges. So I think the public is the last one to get involved, and really, other than some very large orders by people who are paying attention, I would say the public at large is not involved in this market hardly at all.
That's
Andy, can I ask you a
amazing to
question?
hear.
Do you
Right.
mind if I
Sorry,
ask you a
Scott, you go.
question? Just to that end, interestingly, I think when retail really did try to get involved was when people were lining up in Australia and it was at that local top, right? So we saw that on the news, and I think that's classic market behavior. What do you think it would take for the classic 60-40, the RIAs in the world to finally decide, hey, we need some sort of allocation to precious metals, a 60-35-5 or a 55-5-50, whatever it would be? It seems very strange to me that even with this massive move on gold, you don't hear people advising retail to put it in their portfolio.
Yeah, it's strange to me too. I mean, maybe it's just been so whitewashed out of the ecosystem that they don't think about it. I mean, one of my very best friends is manages $3 billion for Morgan Stanley here in Boca, one of the biggest in the state. And he wouldn't know a gold coin if it fell on his foot, yet their chief investment officer is saying put 20% in gold. So I don't know. I think typically, and maybe this is why there's the whole theory of Elliott wave and Kondratiev wave theory, human emotions that drive the market. I think maybe they have to see it with their own eyes. But, people who are successful, I think, move before the trend. And that seems to me to be the central banks who've been doing this for the last 8 years, and now the sovereign wealth funds, and now the commercial banks. So I don't know. Maybe it just is validation they need to see with their own eyes instead of doing what the biggest money has been quietly doing for quite some time. And you look at how gold has performed. It's really done amazingly well, and it's outperformed most assets. The fact that it hasn't been embraced, I don't know. It's a mystery to me, quite frankly. But I would think that it has to be validated by people's own eyes before you see anything substantive with the public or the local money managers or financial advisories.
I would also think that once it's fully embraced, that usually signals a top. So in the scheme of things, it's probably not even at the top yet, and it's got much more to go, right?
That's the idea. I mean, that's kind of what I'm getting at, is that, I just stopped talking about what I do with my friends unless I'm asked to. By now, a lot of people know what I'm doing, but it's so misunderstood by even people who are very well read. Maybe they just read the wrong stuff. And I got another money manager, ironically from Morgan Stanley, lives across the street from me. And the only time he ever says anything to me is when gold and silver fall. You yell across the street from me, "What's going on with metals?" I want to just say, "Shut up, man." And he never talks to me about the fundamentals. It's buy bonds and retire, blissfully. I just think that it's been whitewashed so much to such an extent that the public doesn't quite get it yet. But you look at a market that, has doubled the performance of the 10-year treasury over the last 25 years. You can take the S&P and with dividends reinvested, which nobody ever does over that same time frame, gold beats it just barely. 9.9 to 9.6. Look at it last year, up 60%, up this year, 60%. At what point do people start to legitimize it? I don't know. But ironically, if you take any asset you can think about, just about, and value it in ounces of gold, going all the way back since 1971, prices are falling in gold ounces. They're going way up in dollars. It just is continually outpacing people's expectations, but yet they don't even notice it. They don't acknowledge it. And here we are with it being one of the best performing assets of the last decade. And it's completely and totally underowned by the public for whatever reason, I don't know.
When I look at what's unfolding right now, I can't help but think how surreal it is that so few people can see what's coming. It's like watching a slow motion avalanche. You see the snow starting to crack, the slope shifting, the ice groaning. But the skiers at the bottom are still sipping hot chocolate, acting like nothing is happening, scrolling through their phones, waiting for someone on CNBC to tell them when to put their helmet on. And the tragedy is that by the time the helmet goes on, the slope is already coming down the mountain, and it's too late to move. That's the dynamic right now. Markets are wobbling. Liquidity is thinning. Paper promises are being questioned. Debt is climbing at a pace that's not just aggressive, it's mathematically impossible to sustain. And while all that unfolds, what are the world's most powerful financial actors doing? They're buying physical gold and silver. They're draining exchanges. They're opening vaults. They're wiring gold across borders on new infrastructure the West pretends doesn't exist. They're behaving as if the paper financial system is nearing the final innings. The public, meanwhile, is buying call options, watching crypto Twitter, and hoping the S&P adds another 5% so they can brag at dinner. The contrast is honestly shocking. I've been in this business for over 3 decades, and I've never seen a split like this. On one side, central banks, sovereign wealth funds, BRICS finance ministries, and commercial banks are hoovering up metal like their lives depend on it. On the other, the average retiree has never held a single ounce in their hand. Some of the biggest money managers in America, smart, capable people, still wouldn't recognize a gold coin unless it fell on their foot. And I say that literally. My neighbor, managing billions for a major Wall Street firm, has told me multiple times that he doesn't own a single ounce of gold. Yet his firm's chief investment officer recommended 20% allocations. Jeffrey Gundlach called 25% not overweight. Michael Hartnett at Bank of America said the world is massively underexposed. Even the IMF quietly told central banks they need more gold reserves to weather systemic shocks. And still, retail investors shrug. What people don't understand, and what they absolutely must, is that gold is no longer a speculation, or a hedge, or some barbarous relic. Gold has returned to its historical role as the foundation of settlement, power projection, and geopolitical leverage. It's the asset that nations turn to when trust breaks down. And trust is breaking down everywhere. You see it in the public statements from the Bank of International Settlements. You see it in the migration of physical bars from London to Asia. You see it in record-setting central bank gold, buying that started in 2017 and is now accelerating to levels we've never seen before. Not even in the 1960s, Bretton Woods unwind. You see it in the construction of parallel gold settlement rails across the BRICS nations. And you see it most dramatically in the failure of the paper markets to meet physical demand. You can't fake physical. You can't print it. You can't create it with a keyboard. And when you have backwardation in silver, a situation where the spot price is higher than the futures price, that's the market screaming that physical today is more valuable than paper promises tomorrow. That is not normal. That is not healthy. And you don't get backwardation in an abundant market. You get backwardation in stress. You get backwardation when physical demand overwhelms the ability to deliver bars. We're watching that happen again, just like 2008, only the stakes are 1,000 times higher. Back then, silver dropped from 21 to 9 and gold from 1,000 to 700, but the physical market evaporated. Not a single mint on Earth could deliver product. The US Mint shut down 6 times. Perth Mint ran out. Rand Mint was cleaned out by a Swiss billionaire flying in on a private jumbo jet. Canadian, Austrian, and British mints were backlogged 12 to 14 weeks. And while the price cratered on paper, the real world went bid only. The market broke. People who didn't own metal before the panic were simply out of luck. That wasn't a theory. That was reality. And I'm telling you right now, conditions today make 2008 look like a warm-up drill. The difference this time is you have the world's largest central banks standing for delivery in size. You have sovereign wealth funds pulling metal off COMEX and LBMA. You have BRICS nations redirecting oil profits directly into gold instead of treasuries. You have settlement systems being built to bypass the dollar entirely. And you have the biggest carry trade in history unwinding right in front of us. People underestimate what the Japanese yen carry trade really means. For 30 years, Japan offered 0% interest rates to the world. Anyone could borrow yen for free, convert it into dollars, and buy assets. From US stocks to emerging market debt to crypto to real estate. It was the largest arbitrage mechanism ever created. Trillions flowed through it. And because the interest cost was 0, the trade functioned like a monetary glacier, slow, steady, predictable, until suddenly it wasn't. Japan raised interest rates. The yen strengthened. And just like that, trillions in leveraged positions flipped upside down. Japanese pension funds hold $1.1 trillion in US treasuries that are now unprofitable after hedging. And the only way to unwind that trade is to sell US assets, buy yen, and repatriate the capital. That pushes US yields higher, forces global traders to unwind, and triggers margin calls across every market that depended on cheap Japanese liquidity. People say, well, the Fed cut rates, but the 10-year didn't move. That's because the rest of the world is selling treasuries faster than the Fed can jawbone the market. And when Japan, America's largest creditor historically, stops supporting the market, you don't get stable yields. You get dislocation. You get credit stress. You get funding crises. You get what we're seeing right now. And in that environment, you don't want paper promises. You want real money. You want something outside the banking system. You want something that settles without counterparty risk. You want something that doesn't default when liquidity freezes. That's why gold has outperformed the S&P for 25 years when priced in real terms. That's why gold has outperformed the 10-year Treasury. That's why gold has outperformed global stock markets. And yet, most investors are still pretending none of this is happening.